All right, welcome back to another episode of Asset Coach and Tax Strategist. Thanks for being a subscriber. If you haven't subscribed yet, please hit that bell to subscribe. If you like our content, give us a thumbs up, add any kind of comments down below in the comment section. Asset Coach Tax Strategist, this is really all focused on, if you've seen any of our previous episodes, all focused on what we call farming assets, and my other book, so Farming Assets as a book I wrote, as well as Economic Termites. And you can find the links down below in the description. So Economic Termites talks about, so we know what termites are, right? And when we have damage, see termites, the damage has been done, blah, 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 right? Okay, so taxes, inflation, time, laws, and regulations. Those are the four major termites. Laws, regulations are politicians. So what are things that we have to deal with to help stay ahead of these things, to understand the ins and outs and all that fun stuff? And really that comes down to the world of investing. Most people have money sitting in retirement accounts, 401ks, traditional IRAs, whatever the case may be. And a lot of times that money's sitting in the stock market, mutual funds, ETFs, stocks, bonds, whatever it is, okay? So I want to make sure it's clear that in this particular episode, we're not giving any investment advice. We're not telling you what you need to do or what you shouldn't do. We're just giving educational information. If you've been a viewer of our content already, you know that's kind of how we are. We're just kind of reading between the lines. I pick articles online, clickbait. I fall for it, clickbait, to really see if there's a particular article that makes sense. But I don't read the articles until I record here. We don't edit these as well. So I edit the very beginning and I edit the very end from a time perspective to make sure hey, welcome to Asset Coach Tax Strategist, or at the end I'll say, make it a great day or see you next time or whatever. And then that time from there to turn off the recording, that gets edited out. Everything else doesn't get edited out. So if I make a mistake, I make a mistake. Oh, well, it's raw. Okay. But so the reason why I say all this is that this particular article is by Motley Fool, fool.com. Okay. And so I've been following them for decades, for close to 2 decades now. And so great content. It's evolved over the period of time. Most of their articles are driven to subscribe to Fool, use their services, all that fun stuff. So that's also a part of the disclaimer. But I found it interesting because the clickbait that sucked me in, I think, is interesting. And so let's see what the article actually says to see if the article is interesting, or it's just the title that is interesting and you just spent 15, 20 minutes with me in a disinteresting article. I don't know. Wouldn't be the first time we've done that, right? So let's hopefully, let's make this exciting and fun, and let's dive right into this. Okay. So, all right. So the stock market is doing something witnessed only 3 times in 154 years. Now you see why I said clickbait, right? That got me. Okay. Now, I apologize for all the ads and all that kind of stuff, all these pop-ups or whatever, but this is, I tried to cut and paste this into Word, but it didn't come over very easily. So this is by Sean Williams. This is published in February 8th of this year. So let's look at some key points. Abundant catalysts, including the rise in artificial intelligence, stock splits, Donald Trump's return to the White House, have sent the Dow Jones Industrial Average, S&P 500, NASDAQ Composite soaring. A historically flawless valuation tool is foreshadowing trouble for Wall Street. Time in the market consistently trumps timing the market. Now, this is not capitalized, so this is not President Trump. They're talking about the word trumps, the action of trumps. And then top 10 stocks we like better than the S&P 500 index. Okay, so like I said, they're going to pitch their thing. Let's find out what this content, what's this thing 3 times in 154 years? If things seem too good to be true in Wall Street, they might be. For more than 2 years, the stock market has been virtually unstoppable. Last year, the iconic Dow Jones, the broad-based S&P 500, and the innovation-inspired NASDAQ Composite galloped higher by 13%, 23%, and 29% respectively. So the Dow Jones was up 13, S&P 500 up 23, and the NASDAQ up 29%, with all 3 indexes notching multiple record closing highs. Investors haven't needed to dig too deeply to locate the catalyst fueling this extended rally in equities. In no particular order, the powder keg of the current bull market includes the rise of artificial intelligence, better than expected corporate earnings, A pullback in the prevailing rate of inflation from a 4-decade high, a resilient U.S. economy, the return of Donald Trump to the White House, investor euphoria surrounding stock splits. Okay. And I don't necessarily know if so many investors are like, oh, yes, stock splits are coming, right? So I would say, yeah, okay, Donald Trump, AI, and then the rest of it just kind of follows into line. Okay. While nothing has slowed this bull market rally, history has often shown that when things seem too good to be true, they usually are. All right, the stock market has reached this point only 3 occasions since 1871. Wow. All right, so that's 154 years. So if you don't know the math, it's 1871. That would be me. At any given time, there is bound to be a data point, metric, or forecasting tool that spells potential trouble for the U.S. economy and or Wall Street. Some of the more recent examples include the first notable year-over-year decline in U.S. M2 money supply since the Great Depression. This is important. This is important. Let's click over here really quickly. I'm sorry. I just think this is important and it can't be lost on what's happening. Money supply recently did something last seen during the Great Depression, and it's historically a precursor to a big move in stocks. So what happened? The U.S. M2 money supply has declined by at least 2% on a year-over-year basis just 5 times since 1870. That's what it was talking about. That's a big deal. Okay. That's a big deal. M2 money supplies liquidity in the economy. Okay. But among the what ifs for the stock market, none screams louder than a valuation tool that is making history for the 3rd time in 154 years. This is not a valuation software. This is probably something that is a ratio or some kind of calculation to watch things. So let's see here. As the old idiom states, value is in the eye of the beholder. Value is actually beauty is in the eye of the beholder, I think is what we used to say. But actually, value is in the eye of the beholder. Value is a relatively subjective term, and what one investor considers to be pricey might be viewed as a bargain by another. The traditional valuation tool on Wall Street is the price to earning ratio, PE ratio, which divides a company's share price into its trailing 12-month earnings. While the PE ratio is a quick value comparison tool for mature businesses, it doesn't work particularly well with growth stocks and can get easily skewed during turbulent events such as the pandemic. All right. A considerably more comprehensive valuation tool that allows for apples to apples comparison is the S&P 500 Shiller PE ratio, which is also referred as the cyclically adjusted PE ratio or the CAPE ratio. The Shiller PE ratio is based on average inflation adjusted earnings from the previous 10 years, which means that shock events won't be able to skew the readings. Fair enough. Like it. When the closing bell rang on February 5th, the S&P 500 Shiller PE crossed the finish line with a reading of 38.23. For context, the average reading of the Shiller PE when back tested to January 1871 is just 17.2. So it doubled, more than doubled. Okay. What's even more noteworthy is just how rare the magnitude of this deviation is above the historic average. Spanning 154 years, this marks only the 3rd time during a continuous bull market that the S&P 500 Shiller PE has reached a reading of at least 38%. The other 2 incidences include all-time high in December of 1999 of 44.919 and the week of January 2022, the peak of just over 40. Uh-oh. I see where they're getting at. I don't know if you do, but I do. I see where this is coming. Remember 1999, what happened after that? Remember what happened here. The former occurred just prior to the bursting of the dot-com bubble. Yep. Which saw the S&P 500 NASDAQ composite respectively lose 49% and 78% in their value at the peak to trough basis. Value to peak to trough means that at its peak, the highest it was to the lowest it was. Not from a year of, so like when we look at 2000, 2001, 2002. It's that calendar year. What this is saying is from 99 peak all the way to 2001, 2002 valley trough. Okay. All right. Meanwhile, the latter gave way to a bear market for the Dow Jones, S&P 500, and Nasdaq Composite between January 22 and October 22. Widening the lens a bit further, finds only 6 instances, including the present, where the Shiller PE ratio has surpassed 30 during a bull market in 154 years. All 5 previous occurrences were followed by declines ranging from 20 to 89% in at least one of the 3 major stock indexes. Admittedly, the Shiller PE isn't a timing tool and provides no clues as to when equities hit a temporary top, but when back tested 154 years, it does have a flawless track record for foreshadowing eventual and significant downside in the stock market. Time in the market trumps timing the market. While history rhyming and sending the stock market notably lower may not be what investors want to hear, there's a critical difference when it comes to trying to time short-term market moves and putting your money to work over long periods on Wall Street. The blunt truth is that no matter how much we wish against stock market corrections, bear markets, crashes, and economic downturns, they're a normal and inevitable part of respective investing and economical cycles. But what's vital is recognized in that cycles for the U.S. economy and stock market aren't mirror images of each other. For example, the U.S. economy has worked its way through 12 recessions since World War II, came to a close in September of 1945. Spanning nearly 8 decades, 9 out of 12 recessions were resolved in less than a year. According to a report, and a recession is basically 2 consecutive quarters of negative economic growth. Okay, just so you know. According to the report of Congressional Research Services, the average recession from 1945 through 2009 endured just 11 months. Not bad. That's great, right? So, oh no, we're in a recession. Okay, quick turnaround, 9 of the 12. The other 3 probably took about 18 months or so. Okay, maybe a little bit longer. On the other hand, the CRS, which is the Congressional Research Service, notes that typical economic expansion struck around 58 months between 1945 and 2009. For nearly 5 years, prior to the COVID recession taking shape, the U.S. economy was enjoying an expansion for over 10 years. So 10-year expansion, pandemic. Goes down, recovers. So what they're saying is that probably 58 months or 5 years growth. Where are we at? Pretty much there, right? 2025. In other words, even though economic downturns are inevitable, they're historically short-lived. This same cyclical non-linearity can be seen on Wall Street. So here we go. This is a breakdown. Let's see here. The data set above was posted on June 2023 by the researchers at Bespoke Investment Group shortly after the benchmark S&P 500 was confirmed to be in a new bull market. Okay, so this is what it looked like. So here's the periods of time. So let's see. The S&P 500 is now up 20% from its 10, 12, 22 closing low. The prior bear market saw the index fall 25 over 282 days. And that's what happened. We had a drop, right? And then it went up. Okay, so that's what this is showing. So over here, and this is interesting. So over here is a period time loss. So those recessions, so to speak. And then in this column here, right here, let's get a different color. This column here, can't see that very well, but hopefully you can. This column here is the recovery. So let's say, for example, in November of 80 to August of 82, it went down 622 consecutive days for 27.1%. Recovering then that same day, August 12th, 82, all the way for 5 years to August 25th, 87, almost to the date. 1,839 days, it went up by 228.8%. So that's how to read this. So that's interesting. That's very interesting. Something to be aware of, right? Okay, so after the research, bull market, it examines the length of bull to bear markets, a widely followed index dating back to the start of the Great Depressions in September 1929. In the 94-year period examined, the average S&P 500 bear market took 286 calendar days to complete, or about 9.5 months. What's more, the lengthy bear market on record endures for 630 calendars in the mid 70s. On the other hand, the data set found the average of 27 S&P 500 bull markets lasted over 1,000 calendar days, or roughly 3.5 times longer than the typical bear market. Further, if you include the current bull market rally, over half, 14 out of 27 of all the bull markets have stuck around longer than the lengthy bear market. Short-term moves. So this is interesting. So then that's the end of the article, really. It ends here. So what I find this to be very interesting is that you don't have to time the market. You can look at and see how things are. If all of a sudden you start seeing that we're going down again, this is not an investment advice. This is my own kind of that bestoke and some of those guidelines. The news is going to tell you, oh my goodness, we're in a recession. The news is going to tell you the market's down for blah, 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 blah. The news is going to tell you this. This is not investment advice. This is not even investment research. The news is going to tell you that over the, and you're going to be able to see it. Go on Yahoo Finance as an example. Look at the charts. You'll see. And then you'll know, oh, shoot, okay, well, maybe I should put some more extra money into it, because typically, if we're in a recession or we're in this type of bear market, this is what a bull market would look like, right? You're not timing, but maybe you put a little bit more into it. I don't know. Maybe take some money out of the cash, or maybe take some money out of the conservative, put it in that. I don't know, right? But I find this article interesting. If you found it interesting, great. Go take a look at it and do your own research. Again, clickbait worked. I thought that was very, very interesting. Sounds good. So anyways, I don't know. If you liked it, give me a thumbs up. Go ahead and subscribe if you hadn't. Add some comments below. Do you want to see more of this too? That's probably helpful to know if this is something you want to see more. There's a crap ton of articles that come out about this stuff. I've just kind of walked away from it and left it alone, because I don't really want this to be an investing YouTube channel, and we're not giving investment advice. But every once in a while, I'll throw that in to make up that time, economic termite time, right? Understanding how time works with our wealth. This is a very valuable article to understand that economic termite. So anyhow, hopefully that was helpful. I appreciate it, and you make it a great day. See you later. Bye.